Welcome, everyone. Mark Trice, founder and lead advisor at ClearVista Financial. Um, Thank you all for joining us for our December 2024 market update. I hope you had a wonderful Thanksgiving and things. The price of turkey had supposedly gone down, but all the trimmings and things had gone up. So it'd be interesting to see what our consumer price index ends up for the month of November. We're still awaiting that data, but let's kind of review the month and talk about what we're looking for going forward. So today we'll talk about those index performances. Some general comments. I think that now that the election is over, the market likes a little bit more certainty. That's the one thing the market does not like is uncertainty. And until the election was over, regardless of who won, the markets were going to be a little bit volatile there with that unpredictability. Now that's pretty much settled. We know who's going to be in the House, we know who's going to be in the Senate, and of course the White House as well. So let's jump right in. And of course, if you have questions, you can always text us at 254-282-0495. That's 254-282-0495. And if we get a chance, we will answer those questions on the program today. And as always, this webinar is recorded. We'll put that up on our website sometime in the next several days. But thanks for joining us. So let's jump right in and talk about the S&P 500. So just as a reminder, if you've never been on our webinars before with these market updates, we like to look at these charts called candle charts. And each day, each candle is actually a trading day. It tells you what kind of movement went on through the day, whether or not it gapped up. Red candles are usually down days. Green candles are usually up days. So this is what the S&P 500 looked like for November. You can see after the first few trading days in November, at the beginning of the month, we had this big spike up. And that was right around the election. And we had a little bit of a cooling off in the middle of the month, but we've now gone on to reach new highs. The S&P broke 6,000 for the first time. That was a major point of resistance, and that's good that that has done that. And I don't know what we're doing today necessarily, but the fact that we have reached that new high and broken through resistance is a positive sign. We're coming into that period of the year where there is an increased volatility, but what we're hoping for is a Santa Claus rally, as we call it sometimes, that the year finishes strong, we'll finish up a good year with a good month, and things will improve. We don't know the future. There's a lot of still of uncertainty out there with global conflicts and other things that are going on in the economy. The economy is still growing, albeit at a slower pace. So let's look at the NASDAQ. NASDAQ did fairly well as well, up 6.2%. Remember, NASDAQ is typically more tech heavy. And the good news here is that in November, we found support around that 18,600 level. And that's always good. It kind of gives us a platform from which to build upon. And the NASDAQ tends to be more volatile than the S&P 500, but still good gains in November for that particular index. Let's talk about small caps. Small caps had a great month. After the election, they took off. The winning of Trump winning the White House was seen as a positive sign for small caps. The small cap index was up 11%, over 11% in November. And that index outperformed large caps overall throughout the month. And that was mainly a reaction to the now a little bit more certainty with who's going to be in Washington and the tax policy, things like that. You can see here in the first of the month, there was literally the day after the election, there was a 2-day swing of really 8.45%. That's very rapid. You don't try to chase those things. but it just shows that investors were excited for about the promises of small caps. The interesting thing to note here is that the small cap index still has not recovered its highs from back in 2021. So now we are now 3 years since the peak in 2021, and small caps have still not recovered that previous high. That's going to be until those things continue and merge together. We'll see potential weakness in the markets. All right, let's look at long-term treasuries for just a moment. Long-term treasuries actually had a decent month. Toward the end of the month, yields began dropping again. They were going up in the first part of the month. Um, the long-term treasury was up 1.66%. Now, incidentally, at least through yesterday, this is probably looking like that the long-term treasury index is going to have its third year in a row of declines. And that's very telling. Just shows that that's how much bonds have been beaten up. We signaled a year or two ago that this was the end of a 40 plus year bull market in bonds had come to an end, and it has now. We're still seeing a little bit of recovery, but it remains to be seen as to whether or not that recovery will continue. But we are still way down from the previous long-term treasury highs back in 2021. And we more than likely will finish the year with another down year in long-term treasuries. I think as of this broadcast, the long-term treasury index is down about over 4% for the year. So, that's something not you usually don't see a lot, especially consistently for 3 years in a row that you see that treasury index decline. Something to think about when you're constructing your portfolios or talking to your financial advisor about what you're holding in the portfolios. If they're not reallocating things to different durations and different types of bonds, it may be time to have a conversation with them. Of course, we always have to give the disclosures for these are just indexes. You cannot buy them as an index. There are plenty of other ways to mimic them. But if you're curious and want to talk more about that, you can text us at 254 282 0495. We will take your questions here. And I just had this updated just to look back for 3 years at the S&P 500 and the small cap index. The small cap index was really, that's the blue line on the chart here. The small cap index was really growing and leading well toward the end of 2021. And then we had the bear market of 22, and then a lot of volatility in 23 and early 24. It still has not been able to catch up to each other. And then that's really important because when we see the small cap index really performing really well, that's just showing you that there's a tremendous breadth in the market, and we're still not seeing those two converge. We want to see both of those going up and performing well. So small caps still have a little ways to go, but this is a sign, especially the month of November. It is a sign that that is improving, so that's good. We're in a period of increased volatility right now. This is the S&P 500 index seasonality of volatility. Usually in the early part of the fall, we have a lot of high volatility, and then that tends to wane off towards the end of the year. December, there's usually a little bit of an uptick in that volatility, just meaning how much will the market move on any one given day. And we see that typically that fall off through the first part of January. And as portfolio managers are rebalancing their portfolios in January, we see a little bit more increased volatility. That is not a predictor of the future. This is what historically has happened as far as that trend. So interesting stuff. Just a reminder, you can text us at 254-282-0495, or you can send us a question at info@clearvistafinancial.com. and we'll get back to you. If we don't get to answer on the program today, we'll certainly talk to you offline after the program. So let's talk a little bit about the economy and the interest rate environment. Now, um, the this slide must be for our business development director Jacob because he's a University of Michigan fan. The University of Michigan has a wonderful consumer sentiment survey. This was last updated earlier this fall, and consumers are still not so sure. Here's that consumer index. We're not near as high of a consumer, meaning positive. Consumers feel positive about the future of the economy as we were back in 16, 17, 18, and 19. Um, it has improved over the last year and a half, but it's recently taken a little of a dip back down. That could be because of the uncertainty of the election. We'll see that data come out for November here later this week or early next week. But consumers are still a little bit weary of what the future of the economy holds. And I think primarily is they're still seeing increasing cost at the grocery store. I know the White House reported that the cost of Thanksgiving dinner had gone down by 30%. I don't know which households they're talking to because mine did not go down and yours probably didn't either. So grocery prices are still continuing to go up. I saw a statistic the other day that the price of cereal has risen 30% in the last 2 years. I know if you have young children, that's probably a staple in your house, and that's really important. The cost of insurance, both homeowners and car insurance, have gone up over 50% in the last 12 months. People are getting lots of surprises when they open up their renewal statements and things. It's quite a shock. And of course, the cost of energy has gone up quite a bit in the last few years as well, and that includes utilities and gasoline as well. So prices are still rising, although albeit at not a very high pace. I was looking at statistics for uh, inflation. We've only got through the October numbers. Let me pull this back up. I have to put on my little glasses here so I can see that. So actual year over year, the consumer price index, which measures inflation, was up about 3.3% year over year. That was also close to the core inflation, which measures the common things that the Federal Reserve looks at. It is likely that the Federal Reserve will cut rates in December when they meet in a couple of weeks. We estimate that at the most will be 0.25%. It is possible. It is possible if they see, tomorrow the unemployment numbers come out. If they see unemployment rising too fast, in October it was held steady around 4.1%. If they see unemployment rising too fast and the economy cooling off too fast, they may cut rates. If they see that inflation starting to come back, they may actually hold rates and not do anything, just wait and see. So Treasury rates still remain high, which has been that way for a couple of years now. Really, the yield curve here, and this is what we're looking at here. This was as the last trading day of November. The short-term yields are still higher than the long-term yields. Usually you see this curve inverted, and it's been inverted this way since March of 2022. We haven't seen that happen in a very, very long time. Usually a yield curve inversion where it flips on us usually means that it's a precursor to a recession. We haven't really seen that happen per se as in the traditional ways that the government measures the economy. I will tell you, and we talked about this in our post-election webinar that we did, that we think that we have been in a mild recession for about a year now, simply because producers are not producing as much as they have before. We've seen contraction in that area, and it's important to realize that, yes, you are seeing things slow down and have for some while, It's just with all the data and the way that they measure things, it has not been the characteristic recession that we've seen in recessions past. So, interesting thing to note here: the 1 month yield is around 4.7%. The 30-year yield is around 4.3. The 10-year rate is closely related to borrowing costs for a lot of consumers. That's still around 4.1%. So it's interesting to see rates have actually risen in the month of November. Some of those yields are starting to fall down again, but that affects so many different types of markets or consumer markets, where it be borrowing for a home or borrowing for a car or things like that. We ex we expect there to be another rate cut in December. I don't think the economy has cooled off fast enough that they won't do a small rate cut. It will be interesting to see what they feel like is their forecast for the rest of the year. And this is a historical look at the federal funds rate since 1973. For some of us on the webinar today, you can tell that you remember in the early 80s when interest rates were so high. I was telling Jesse a story the other day about my parents. We had moved. My father was a coach. We had moved from one city back to another, and for a short while, my parents had two mortgages, and those mortgages were 13% and quite onerous at the time, very debilitating sometimes when you're trying to raise a family. But those rates have risen, obviously, in this last 6 months. And we think that they'll begin to cut those, but that doesn't necessarily mean that those cuts will filter through all the way to the consumer. A lot of times the banks will hang on to money and not lend it out at cheaper rates. But it's very telling here. Historically, we still are at low rates. I know a lot of young people that are buying homes are just shocked to find that they have to pay a 6 or 7% mortgage for a 30-year mortgage, and that's actually historically fairly low. And it's all put into perspective in what you're used to. I think we're used to such cheap money in the last several years that if it's not 1.9%, we think it's expensive. So we just have to put all that in perspective. And interest rates have kind of topped out for now, hopefully, but we will see the how that plays out when the Fed meets in a couple of weeks. Okay, so lots of conflicting data. Lots of conflicting data, and I got a question, so I just figure I'll answer that here. I won't call you out, but could the inverted yield curves be a market correction as opposed to pretending recession? Yeah, you do typically see. Thanks for that question. You do typically see when the yield curve right sizes itself. In other words, inverted from what it is right now. Let me see if I can go back to that. You tend to have a lot of volatility in the market. That's historically. Historically, doesn't mean that'll happen this way this time around. In fact, one of the most famous sayings that you hear on Wall Street, that this time is different. I don't know that it will, but that volatility will be there as those interest rates start to rise. And the reason for that is the cost of borrowing and doing business becomes greater, and that can impact, performance of companies, and especially public companies and things like that. So great question. Thanks for bringing that up. So what does it all mean for you? We hope there's a Santa Claus rally. We hope there's some wonderful gifts under the tree for you for the rest of the year. We don't have a crystal ball, and we can't really tell you what's going to happen in the future, but we do know that these conditions have led to a recession. I believe, based on our data that we're looking at, that we've been in a mild recession for some time. The government may never report that, but the important thing is what's your strategy? How are you going to deal with those changing environments? So these are still the main points, this carrying over from last month, that are going to likely impact those of you listening today. Inflation is increasing at a slower pace than in the last 18 months, but we still can't forget that inflation is going up. Every day, items are more expensive. We've shown how the market signals are mixed, and we'll continue to watch those closely. indexes are rising. The large cap indexes have set all new time highs this week again. And whether or not that momentum will continue remains to be seen. Bonds are still struggling because interest rates are still high. And that impacts those that are trying to buy something and finance it. This also means that CDs and different savings account, if you're lucky, maybe you're still paying reasonable higher rates than you've seen in the last 7 years. So it's a good idea when you see those specials. If you've got a CD renewing or something, you might want to give us a call. We can search around for you and tell you what the local rates are, or we go to someplace like bankrate.com and we can look at national rates. Credit card debt still going up. We still haven't learned that. Money supply, personal money supply, that's M2, is falling. That's a sign that there's less and less liquidity in the markets. And, we've got some of that anxiety that comes with elections, but some of that has settled down now that the election is over. All right. What's the solution for all this? And everybody wants to know the answer to that question. We try to adapt to this dramatic shift as it happens. And that's one reason why we choose to manage our clients' investments with some technical analysis and active risk management. And as the indexes continue to rise, we'll take advantage of any opportunities the markets present. And we'll also continue to navigate that bond market with a good bit of caution. We always encourage our listeners to, not to panic or make decisions based on headlines. I still get questions from folks wanting to know if, since so-and-so was elected or since so-and-so was not elected, what does that mean for my portfolio? I'm scared. You don't need to be scared. We've done this before. We've all, as Americans, been through different economic cycles. And you often hear that, but really it doesn't matter who's in the White House, who's in Congress, as to how it really impacts your investment decisions. You need to invest for the long haul. And we still believe that the U.S. futures is relatively bright. The economy will continue to operate no matter who is in the White House or in Congress, and no matter whether there's a recession or not. So if you have a 401k at your workplace, you're curious about it, maybe it hasn't done as well as you thought you would have seen it today, because a lot of those of you are in target date funds, and sometimes those has forced allocations to global investments, forced allocation to bonds, and they might not be doing as well as you had hoped this year. Certainly not near as good as any of the indexes. We'd love to talk to you about that. We do have solutions that can help you navigate that through various times of market volatility. Okay, so the year's almost over. Take a moment to check your statements. Talk to your professional financial advisor. If you don't have one, we'd love to talk to you. And more importantly, educate yourself. There's so much bad advice out there. I forgot what the term is, but it's these TikTok financial advisors that they're not financial advisors, but they're called finfluencers. Finfluencers, and they've got social media influencers. These are finance influencers. Some of them are maybe 22 or 23. And I got to tell you, when I was 22 or 23, I thought I knew a lot of stuff, but I didn't know anything. And so talk to a professional that's been working in the industry for some time to get your questions answered. So I'm not seeing any additional questions on the board right now. And we'll talk to you again at the beginning of the year. As always, if you have questions, you can contact us at 254-282-0495. Then you can text us there. You can also visit us on the web. We have a lot of resources. We'll have this webinar recording up, and we hope to talk to you soon. Thanks for giving us a listen today. Have a wonderful holiday, Merry Christmas, and a blessed New Year. Thanks for joining us.